Hello, hello. I'm Erin Aid. This is Boom Bust, and these are some of the stories that we're tracking for you today. First up, the Russian ruble hit new lows on Tuesday despite a midnight interest rate hike. We'll tell you what this means for the global economy moving forward. Then Rick Rule is on the show. The CEO of Sprott Holdings sat down with me to talk about the natural resources sector. And Boom Bust all-star Mr. Jim Rickards, he dropped by our New York studio earlier today to weigh in on the global economy. Then in today's Big Deal, Edward Harrison and I are talking about tail risks and fat tails. It all starts now. Our lead story today, Russia. Now, the ruble plummeted Tuesday, sinking at one point to be on 80 to the dollar and losing as much as 19% after a surprise interest rate hike failed to stem the run on the Russian currency. Shortly after midnight Monday, the Russian central bank raised interest rates from 10.5% to 17%. However, that didn't stop the free fall. The ruble has plummeted more than 50% this year, even after the central bank spent more than $80 billion on intervention. Currency interventions have also been draining the nation's foreign reserves, while the cost of a depreciating ruble is steep, with inflation hovering at three-year highs. Early Tuesday, the ruble fell the most in a single day since the country defaulted and devalued its currency back in 1998. 10-year ruble bond yields jumped over 3 percentage points, while the annual cost of insuring against a debt default climbed over 5%. The question now becomes capital controls. Guards against Russian citizens and businesses withdrawing money from the banks are looking more and more likely as the central bank is running out of options to stem the tide of fleeing money. The 49% drop in oil over the past 6 months precipitated the ruble's fall, which undermines the stability of the economy. An economy which was already wavering under international sanctions. As of Tuesday, oil retreated 3.3% to just over $59 a barrel. Oil accounts for roughly 50% of Russia's revenue, along with natural gas. And Monday, Russia's central bank said that its GDP may shrink to 4.7% next year if oil averages under $60 a barrel. So, as of now, there are no signs of Russians lining up at banks to pull their ruble deposits out and buy dollars, at least not yet. However, it's being reported that demand for foreign currencies at some retail banks has increased by 3 or 4 times the daily averages. I mean, whatever happens next, we'll be watching, that's for sure. To get some insight into the natural resources sector, I sat down earlier today with Rick Rule, CEO of Sprott Holdings. Rick and I had a lengthy discussion about the energy markets, and I asked him how hedging will protect oil exploration and production companies moving forward. Take a look at the interview. Rick, with all the volatility ongoing in the natural resource sector, we wanted to get your view on where the pitfalls are today. So let's start with oil companies. I mean, obviously, that's a very big topic of conversation lately. And, you know, the Royal Bank of Canada has indicated that 35% of 2014 oil production in major and mid-sized upstream oil companies is hedged with an average price of $95.50 a barrel as of November. But some companies like Devon Energy have much larger hedges in place. So how much is this hedging going to protect these companies?
I think the next 9 to 12 months will see some of the more prudent companies, like Devon, as you mentioned, protect cash flows reasonably well. The problem will be in the more aggressive producers. Some of the U.S. Shale producers, as an example, that employ too much leverage on the balance sheet, had capital budgets way in excess of their free cash flow, and we're playing the leveraged game, in other words, leverage to the higher oil price. I think the results are going to be very mixed. Investors are going to have to look for at least another quarter in terms of the operating statements of the oil companies to see how much of the cash flow came from financial operations, i.e. hedging, and what sort of margin there is for these producers at $60 or $65 oil. It's going to be a very interesting quarter, to say the least.
And what about 2015? I'm hearing only 14 or 15% of production is hedged, and that means producers are going to be making a lot less money, no?
I think that's absolutely correct. You know, if you take a $90 pro forma into a $60 world, the $30 that comes out all comes out of margin. If you assume that these companies' all-in costs, including capitalized G&A, is $40 or $45 a barrel, at $90 a barrel, they were enjoying 50% operating margins. At $60 a barrel, it's much less pleasant, particularly when you're expected to return some of that capital to shareholders by way of dividend.
Absolutely. Now, do you think energy names are oversold here, or do you see more bloodletting coming?
I think that depends on the energy name. Some of the larger integrated producers will do reasonably well in this price environment. They have interesting businesses in that when the crude prices are high, they make money in exploration and production. When crude prices are low, the margins in refining and marketing get fatter. So some of the senior oil companies will get through this fairly well. Some companies that are energy related, an example would be the midstream processing and pipeline transportation companies, will do fairly well. My suspicion is that if low oil prices sustain, the oil service businesses are really going to get slaughtered. The capital budgets for 2015, 2016 will get cut in a way that we haven't seen yet. Companies that have reduced their rig count, their active rig count from 20 to 15, may end up reducing it to 5, which will be okay for the producer. They'll limp through, but it would likely, in that case, be catastrophic for the oil service businesses.
Rick, where are the buying opportunities in the natural resources space right now?
Well, I think there are buying opportunities coming up in the oil and gas sector. I suspect by the end of 2015 that both oil and gas will be sort of parenthetically 4-letter words as opposed to 3-letter words. What's hated right now? I would suspect that coal is hated right now. Hated more because the decrease in natural gas prices will put additional pressure on coal. I think uranium is hated right now. I think that the platinum and palladium sector, which we've talked about before, at least in terms of buying the physical metals, has a pretty attractive outlook. And I'm reasonably attracted to the better precious metals producers. I don't think they're cheap, but I don't think that they're ever cheap. I think that the industry has gone about a quarter of the way that they need to sort of redeem themselves from their operating and investment failures of the past. And so that looks fairly attractive to me. And of course, I always like, although it's very difficult to play, the U.S. water business.
Interesting. Now, Russia, Rick, it's very levered to oil, and international energy companies like Gazprom and Lukoil are trading at a price of 2 times earnings. That's ridiculously low. So is this a buying opportunity?
I'm embarrassed to say I don't have the courage to buy either Gazprom or Lukoil for my clients, but I've bought them both personally. Russia is hated, oil and gas is hated. The ability for the Russian oil and gas industry, if it were allowed to by the state to reform itself and become more efficient, is very large. So the upside running room, assuming that politics doesn't get in the way, and of course that's a difficult assumption for Russia, provides so much upside that I personally, as a speculator, couldn't resist the opportunity. As I say, I haven't had the courage to do that for client accounts because I'd rather risk my own cash as opposed to my reputation. But a contrarian speculator has to look at the energy sector and has to look at Russia and has to say, every part of my training tells me that this is one of the most hated sectors in the world, and thus it probably has to be owned.
Well, I know if your PA is in it, something worth looking at, that's for sure. Now, you know, when I tune into financial TV, I hear everyone acting like the ruble's fall weakens Putin's hand significantly. So do you believe that that is the case?
I do. I believe that the Russian economy, with the exception of the energy sector, is an absolute basket case. I think that a falling ruble would give a Russian manufacturing sector, if one really existed, an interesting leg up, but I struggle to find a global industry other than energy that Russia is competitive in, with the exception of low-end weapon sales, where they're beginning to run into competition from other places like India. So it's difficult for me to see how a lower ruble can do anything other than hurt Mr. Putin's foreign policy aspirations.
And what about Canada? You know, ostensibly the country is levered to natural resources, and that's going to be a problem for the economy and for the currency. So how are you looking at Canada in terms of the natural resources sector?
Well, I agree with you completely. I think the current fiscal stability of Canada is due to two very fortuitous circumstances. One, the fact that the country, pardon me, was borderline insolvent in the early part of the 1990s. The consequence of that was that Canada was effectively frozen out of credit markets and therefore didn't borrow. It wasn't that Jean Chrétien was fiscally prudent, it was that he had no alternative other than fiscal prudence. And the consequence of not being able to borrow is that they didn't. They were under-levered relative to other Western economies. The second great thing that happened, of course, is that Canada was richly endowed with oil and gas. And the ability of the state to receive 25% of the economics from the energy business by way of the social take, royalty and tax, has done a wonderful thing for Canada. Unfortunately, Canada, as a consequence of strong energy prices, has been able to return to credit markets, and they have done so with some gusto, at the same time that the energy price has fallen. So I think on a political level, Canada is going to have an interesting time adjusting to their new fiscal reality.
So cheeky, that Rick. That was Rick Rule, CEO of Sprott Holdings. Time now for a very quick break, but stick around because when we return, Jim Rickards will be on the show. Jim dropped by our New York studio earlier today to talk to us about what he sees in the global economy right now. Then in today's Big Deal, Edward Harrison and I are discussing tail risks and crises. And remember, you can see all segments featured in today's show on YouTube at youtube.com/boombustrT and on Hulu at hulu.com/boom-bust. Now, as we go to break, here are a look at some of your closing numbers at the bell. Come on back with us.
Let's get something straight. John F. O'Donnell will do anything to piss off corporate vampires. Sam Sachs used to work on the Hill. Now he can smell a lobbyist from a mile away. Yeah, have a nice one. And I'm Lee Camp. I came here to throw truth in the faces of the powerful, because the truth is irresistible. Well, not to everyone.
I don't prejudge anything.
I listen to you every morning.
Hello, this is Larry King.
I wouldn't lie to you.
Oh, I wanted to do this when I was 6 years old.
I will always be grateful to you, Larry.
It was in my blood from the start.
I don't have an agenda.
And you allowed me to come on your show and clear my name up.
Being interviewed by you is like taking a ride in the passenger seat with Richard Petty.
I didn't have a lot of people I could talk to. You let me sit down with you and talk.
I'll just ask questions.
Join me, Edward Harrison, and Aaron Aid as we discuss the myths, the rumors, and more importantly, the facts around the world's most fascinating new currency, Bitcoin.
Welcome back to the show. Up now is my interview with Boom Bust favorite, one of my very favorites, Mr. Jim Rickards. Now, Jim is the chief global strategist at West Shore Funds and author of the best-selling book, The Death of Money. Now, I first asked Jim for his take on the juxtaposition between the decline in oil, collapse in the ruble, and the commentators that seem so bullish on the economy. Here's what he had to say.
We had a near meltdown of the international monetary system in 1998. We had another one in 2008. You know, I'm a big baseball fan. I think 3 strikes, you're out. If we have another financial meltdown, we may not recover so easily the next time. So I agree with the idea that there are a lot of unforeseen consequences. Look, oil has come down, 40% just in a matter of months. That's one of the 3 largest, fastest declines in the price of oil ever. It's a very significant loss. Now, this whole idea that puts money in consumers' pockets, sure. I'd rather pay $2 for gas than $4 for gas. And if you use 100 gallons of gas a week, that puts $200 in your pocket. But first of all, it doesn't mean consumers will spend it. They might use it to pay off their kids' student loans or their own student loans. That's the first problem. It doesn't all go into consumption. But the second problem is it's a zero-sum game. For every winner, there's a loser. There are trillions of dollars of junk bonds issued by oil exploration companies and oil development companies since 2009 out in the marketplace that were priced on the assumption that oil would be between $80 and $150 a barrel. But with oil at 60 or even lower, some percentage of those bonds are going to default. Where are those bonds? Well, they might be in your 401k, and that's the problem. They might be in the banks. And so those losses are going to cascade through the system, and this could easily spin out of control. So I agree that there are unforeseen consequences and hidden losses. I'm not quite so sanguine that this is all going to work out smoothly in the end.
Jim, you were at Long-Term Capital Management in 1998, so you know a thing or two about crises. Is this a crisis, Jim?
It looks like the beginning of one. I have to say, I'm very slow to say, gee, it looks like a crisis, because I've seen big events happen and they just kind of go away and nothing bad comes of it. But this does have that familiar feel to it. In 1998, the last time Russia melted down, it ended up in my lap. I was general counsel of Long-Term Capital Management, and we were caught in the eye of the storm, had to be rescued by the Fed sponsored a Wall Street bailout, and I negotiated that bailout. So for me, this is sort of deja vu all over again. But remember, that crisis, which came to a head in September of 1998, actually started in Thailand in June of 1997. And then it spread to Indonesia, then Korea, then Russia. Then everyone was expecting it to go to Brazil, and up popped Long-Term Capital Management, a hedge fund, not exactly a country, but I guess we sort of played that role, and then that's where the crisis crystallized. So that's an example how it can take a year or more to play out, and it pops up in unexpected places. So we're seeing a financial meltdown in oil and in the Russian ruble today, but don't be so sure you know where it's going to end up. So what happens is people just kind of run for liquidity. They say exactly that. They say, there are going to be big losses out there somewhere. May not know exactly where they are, but just get me out of stocks and bonds, get me into cash, get me into some hard assets. I'm just going to go to the sidelines. That's what starts the liquidity crisis. So let's see. I don't want to be too, kind of melodramatic, but that's how these things start, and this could be a big one.
Now, the latest decline in oil prices was precipitated by weak economic numbers out of China. So do you think China's growth rate is going to decline from here?
Well, I think China's growth rate is going to decline for a lot of reasons. Sort of cause and effect. The oil is a little more to it. You have China slowing down. Oil is, supply and demand is economics 101. So demand is declining to a great extent from China because China is slowing down, but also Japan and elsewhere around the world, Europe, et cetera. And then supply is going up because of fracking and technology, and OPEC is not cutting enough to support the price. Less demand, more supply, you're going to get a lower price. So that much is fairly straightforward, although, there's always a little something going on behind the scenes in terms of the geopolitics. Does Saudi Arabia want to hurt Iran because of their nuclear program? Does Saudi Arabia want to hurt Russia because of their support for Assad in Syria? I mean, there's some things going on behind the curtain. But getting back to China, their growth is slowing down anyway. First of all, their numbers are overstated. I don't mean they completely make them up. I just mean that so much of Chinese GDP is investment that's being wasted. Not all of it, but a significant percentage of it, maybe half. And so if you adjust Chinese GDP for the portion of investment that is just sort of flushed down the sewers, their actual growth is more like 4.5%, and it may slow down from there. So look, China's slowing down. Japan hit the wall this year. I mean, they're in desperate trouble. Europe is in recession. I think the U.S. could be very close to recession. That's why I don't expect the Fed to raise interest rates in 2015. The whole world's slowing down. So you see it in oil, you see it in Russia, you see it in a lot of places.
Jim, where specifically is the risk in financial markets right now?
Well, it's hard to, it's all over the place, actually. Let me just give you a concrete example. So we see the Russian ruble, collapsing, and I saw a headline today saying Russian ruble's in trouble. Well, currency can't be in trouble. Currency is just a currency, right? The currency is not a stock, it's not a bond, it's not a borrower, it's just a currency. So where is the problem? Well, if you look at the Russian government, they don't have that much external dollar-denominated debt. And they have enough reserves to more than cover their external debt. So the government's not in trouble. Now, corporations, sure, some of them have dollar-denominated debt, but a lot of them earn dollars. So, a company like Rosneft, they may have borrowed in dollars, but they sell oil and they get paid in dollars, so they may be okay also. So the real loser is, if there's a Russian company, for example, that borrowed in dollars but makes money in rubles because they sell, maybe a large auto dealer in Moscow, they got to borrow dollars to buy their inventory and they sell for rubles in Russia. Those types of companies could be in trouble. But where are the bonds? Those bonds are in European banks and U.S. 401ks. So, there's some Americans kind of rooting for all this Russian distress. And I think geopolitically, the White House is trying to, in effect, use financial warfare to attack Russia because of actions in the Ukraine. But be careful what you wish for, because if there's Russian dollars-denominated corporate debt, it could be in U.S. 401ks. So this is a good example of the interconnectedness of the world today. So I guess my advice to investors would be, kind of look in your 401k, see what's there, and also be ready for unintended consequences and be careful what you wish for.
Jim, why did the rate hike in Russia fail to stem the tide?
Well, the currency is still convertible for the time being. The Russian, one of the central bank officials said Russia has no intention to put on currency controls. That remains to be seen. I mean, they may have to, although I actually don't think they will, at least in the short run. But we kind of watch that. It's basically kind of a run on the bank, and people with rubles want to get dollars because they think it's going down more. So it feeds on itself to some extent. Now, the whole idea of the rate hike increase, the rate increase, is to say, well, no, leave your money in rubles, we'll pay you a lot of money. We'll see how it plays out. They may have to raise it again. Look, 17% interest rates in Russia. In 1998, the rates were 100%. In 1980, U.S. rates were 20%. So 17% is not unheard of. And I do think that Russia has a competent set of central bank officials, and they're going to stay on top of the situation. It's, when you have a run on the bank, you can either shut your doors or raise rates. So I think raising rates is a smart policy move.
That was Jim Rickards, Chief Global Strategist at West Shore Funds and author of The Death of Money. Time now for today's Big Deal. Big Deal time with the wonderful Edward Harrison back in action. We're happy to have you here, Ed, especially ahead of our Bitcoin show on Wednesday. Now, we're discussing more than 3 standard deviation points north or south of the mean, also known as tail risk. Little nerd joke in there. I hope you all like it out there. Anyway, Ed, you've been writing a lot about tail risk recently. So, first question, fat tails. What exactly are fat tails? And how do they really relate into all of this? Because that's a big part of tail risk.
Right. Yeah, so basically, when you look at the way that things are distributed in any marketplace, a lot of times people use what's called a Gaussian or a bell curve to represent it. But what we've seen in markets is that they're actually fat tails. That means that more of the points of the distribution are in the tails, the extreme events, either on the downside or the good side. And so what we've seen also is that that's very much related to phenomena in the natural world. thing called fractals. A guy by the name of Benoit Mandelbrot wrote this book about fractals, and had a theory based upon that. And in that theory, basically in natural phenomena, you'll see like a coastline, or you might see a snowflake. And those things are actually scale invariant. Those are things that if you look at it at any scale, they actually look identical, exactly the same. And those things are formed as a result of power laws, which basically means that the scale invariance is causing, something to be related to something else by a power, an exponential power. And so what this does is when you go into the markets at the extreme tail events, they're actually governed by power laws. That means that things that happen are related not in a sort of a bell curve kind of way, but actually in terms of things moving up in an exponential fashion. So that's why we see these exponential moves as things start to collapse. Like you just see the curve going exponential. That's the power law in play, and that's why you have fat tails.
That's really interesting, and thank you for explaining it in such a concise and kind of digestible way. If you think about snowflakes or shorelines, if you put on a scale, it's all going to be the same, it makes it digestible. So well done. Well done, Professor Harrison. Now, I understand that you think that we're in this, heightened tail risk period right now. But, what's your view that zero rate policy kind of amplifies, zero rate policy, it's pro-cyclical, and that it amplifies volatility. What's going on here? What do you mean by that?
Yeah, so basically what I mean is that whenever the economy goes into a tailspin, the central bank has the opportunity to lower rates. And what that means is that people or companies that are indebted have interest rate relief. That means that their debt payments are not as large as they otherwise would be because the central bank has dropped rates to 0%, or they've dropped them lower than they were before. But now we have rates that are at 0%, so there's no opportunity to drop rates any lower than they already are. And what that means is that the full measure, the full weight of the downturn falls on the worst creditors in terms of a gapping up of credit spreads, a gapping up of risk spreads, a gapping up of duration spreads. And so as a result of that, that means that the people who are the worst borrowers, the ones who are the riskiest, they have no ability to be able to reduce their credit, the amount of debt that they're paying. And so you'll see greater numbers of default. And that's what we saw in Japan after they went to zero rates. And I think that that's what we're going to see right now in the U.S. and elsewhere.
It is really interesting. And, I want to ask you, how does this relate to Russia? Is it driving the psychology that kind of makes these outcomes more unpredictable?
Yeah, so I think that, when we get into the fat tails scenario, what we're seeing basically is that all of the stuff that we're being told about the capital asset pricing model, about efficient market hypothesis, where there's no relationship between a former price and the new price, is all false. That there is a psychological element to that, and the closer you get to the extreme market events, the more those elements take over. And so we're in a completely psychology-driven area where anything could happen, and all of the prices are very much related to the previous prices. All the volatility is related to the previous volatility. And that's where the power laws take off, and that's why we're seeing such great volatility in oil and in Russia, and we'll continue to see that.
Fascinating. Now, I have some more questions, and I hope that we can talk about this again. I'm sure that we will, because I was schooled, and I hope all you were too out there. Ed, thank you so much. That's all for now. But don't forget, we have our special Bitcoin special coming up tomorrow, Wednesday, December 17th. And you can send us any questions that you'd like answered using the hashtag BitcoinRT. And you can also drop us a line on Facebook. From all of us here at Boombuzz, thank you for watching. See you tomorrow. Ciao.